The Federal Reserve is running out of ammunition rapidly. With the country spiraling deeper and deeper into recession, the Federal Reserve is now ready to slash its key interest rate, perhaps to an all-time low, a new record, in hopes of cushioning some of the economic fallout felt by many struggling Americans. And to battle the worst financial crisis since the 1930s, Fed Chairman Ben Bernanke and his colleagues have already ratcheted down their main lever for influencing the economy, the federal funds rate, to 1%, a level seen only once before in the last half-century. The Federal Reserve opens a two-day meeting today to assess the economy and decide its next move on rates. Another reduction to the funds rate, the interest banks charge one another on overnight loans, is all but certain to be announced. And many economists predict that the Fed will cut its rate in half to just 0.50%. And a few think the Fed could opt for an even more forceful action, lowering rates by a whopping 3/4 percentage point or more. And if that larger cut occurs, it would be the lowest on records that track the monthly average of the targeted funds rate going back to 1954. Even an aggressive rate reduction won't turn the economy around, economists say, because there's something else going on here. There's something that's bigger than all this going on. Something is happening all around the world. It is not so much going to give the economy a big push forward. It's more a case of trying to help the economy from being pushed further backward by all these negative events, or actually being pushed into a recession. However deeply the Fed decides to cut rates, the prime rate, now at 4% for many consumer and small business loans, would drop by a corresponding amount. The prime lending rate is used to peg rates on home equity loans, certain credit cards, and other consumer loans. Of course, the prime lending rate can also be higher for consumers or businesses, depending on the borrower and the credit scores. Cheaper rates could give pinched borrowers a dose of relief, theoretically. The goal of lower borrowing costs is to entice people and businesses to spend more, which could revive somewhat the flatlined economy. That is the hope. So far, though, the Fed's aggressive rate reductions have failed to lift the country out of a recession that started last December and is getting worse every day, day by day. So clobbered by the financial crisis, worried banks have hoarded their cash and have been extremely reluctant to lend money to customers. Fearful consumers, watching jobs vanish and their investments tank, have sharply cut back their spending, and that drives 2/3 of the economy, consumer spending. So, they have sharply cut back their spending, including big-ticket purchases like homes and cars that typically involve financing. Well, people have to have a job to be able to buy those things, and a lot of jobs are being lost rapidly. And negative forces have fed off each other, creating a vicious cycle that Bernanke and Treasury Secretary Henry Paulson have been desperately trying to break, to unlock lending and get financial markets to operate more normally. The U.S. has resorted to a string of radical actions, including a $700 billion financial bailout, where the government is injecting cash to banks in return for partial ownership stakes. That could be a risky strategy. And in terms of rate cuts, the Federal Reserve is getting ever closer to running out of ammunition or things that they can do. It can lower the funds rate only so far to zero. Even if that were to happen, a point of debate among economists. The prime rate would fall to 3% but no lower. And against that backdrop, Bernanke says the central bank is exploring other ways to stimulate the economy, whatever that may be. And the Federal Reserve could buy longer-term Treasury or agency securities on the open market in substantial quantities. He says this might lower rates on these securities and help spur buying appetites. Again, supposedly. Another option the Fed has mulled, issuing its own debt, which would give the central bank cash and perhaps more flexibility to battle the financial crisis. But to do that, however, the Federal Reserve would need new powers from Congress, which could be unlikely. The Federal Reserve wants to show that it has tools and options and is not out of tricks because interest rates are very low, said one economist at J.P. Morgan Economics. The problems holding back the economy are fairly long-lived in nature. So, to combat the financial crisis, the Fed has already created first-of-its-kind programs such as getting cash directly to companies by buying up huge mounds of commercial paper. The short-term debt firms use to pay everyday expenses such as payroll and supplies. It also has recently launched massive programs to boost the availability of consumer credit. But once again, if people don't have jobs, it's kind of hard for them to get credit. And including that for cars, student loans, homes, and credit cards. The Federal Reserve is also making loans to banks, is providing a financial backstop to the mutual fund industry, and has injected billions and billions of dollars in financial markets here and abroad. The Fed could opt to expand programs by enlarging loans it's now making, providing loans to other types of companies, or buying more and different types of debt. The Fed's balance sheet has ballooned to $2.2 trillion from close to $900 billion in September, reflecting some of those other activities to get credit flowing again. Even with all the bold moves, the economy continues to sink deeper and deeper into despair. Skittish employers axed or cut 533,000 jobs in November alone. That drove the unemployment rate up to 6.7%, a 15-year high. And since the start of the recession, the economy has shed approximately 2 million jobs and still rising. Economists predict another 3 million more jobs could possibly be lost by next year. And that's a lot. Last week alone, Bank of America Corporation, toolmaker Stanley Works, and Sara Lee Corporation also announced job cuts. General Motors Corporation, Chrysler, LLC, and Ford Motor Company, meanwhile, are fighting for their very survival. GM and Chrysler have said they're in danger of running out of money within weeks. With the employment market eroding and consumers retrenching and cutting back, the economy could stagger backward at a shocking or astounding 6% rate in the current October-December quarter. Economists predict it shrank at a 0.5% pace in the third quarter. President-elect Barack Obama is advocating an economic recovery plan that includes spending on big public works projects to bolster jobs. And once again, well, if the economy is in recession and people are losing their jobs, and consumers drive 2/3 of the U.S. economy, that's the ripple effect, or the spiraling downward effect. Anyway, there's something bigger going on here, something more, and all this is connected to everything else that's going on in the world at the present time. And all these are more signs of the end times, transition days. And yes, there are many. many signs.